Chapter 8: Valuation of Inventories, a Cost Basis Approach. Chapter 9 is also about the inventory valuation, but in a different approach. In this chapter, we are going to talk about the definition of inventory, the conceptions, the cost flow, and the control of inventories. Second is, we use merchandiser as an example to talk about when and how much inventory acquired can be recorded as asset. This part is about inventory acquisition. The third part is inventory valuation based on different cost flow assumptions. So here we should distinguish the difference between physical flow and cost flow. Physical flow is a movement of inventory in a business physically. Cost flow is about accounting, which will affect cost of goods sold and ending balance of inventory. We also will cover some special issues in inventory. We know inventory usually is reported as current assets. The inventory is considered assets because it can introduce the future value for the owner or the firm. If the firm sells their inventory, the firm will generate revenues and the cash flows. When inventory are sold, so inventory as an asset will turn into expenses. We use cost of goods sold or cost of sales. So this is asset. This is expense. The assets will finally become expenses. And for inventory reporting, depends on the industry. The inventory reporting are different. So in this class, we just talk about the merchandiser and the manufacturer. So the merchandiser is very simple, just a single inventory account. When the firm purchases, the inventory will increase. When the firm sells its inventory, the inventory will decrease. The example is like Walmart, Target. When they purchase their goods from the suppliers, Asia, Mexico, their inventory will go up. When they sell the inventory will go down. The inventory is reported following the accounts receivable. For the manufacturer, the inventory classification is a little bit complicated because manufacturers have to purchase material, turn the raw material into work in process. I also use WIP as an abbreviation of work in process. When all the costs are incurred, the work in process will become finished goods, and the finished goods will become cost of goods sold. When we report inventory for manufacturing industry, we will see the three inventory accounts. So this is a chart to show the cost flow of inventory. You probably have seen this in managerial accounting. So for the merchandising company, the cost flow is simple. When the firm purchases, the inventory debit, right? So this is the left of the T accounts. Inventory purchase, debit inventory. When the inventory sold, credit. At the same time, we will debit cost of goods sold, which is the first expense reported in the income statement. For the manufacturer, raw material, cost of labor, and overhead cost will first be capitalized as assets. So we know these are all expenditures, right? but we do not expense them until the finished goods are sold. So we first capitalize all the expenditures as work in process. Then, when the work in process is finished, it will become cost of goods manufactured. So the work in process will move out from this account to the next step, finished goods. When the finished goods is sold, we're going to credit finished goods and debit cost of goods sold. To simplify, in this chapter we're using merchandising industry as example. So this chart basically is, a beginning inventory plus purchased. So the sum of both is the cost of goods available for sale. These goods will either be sold and become cost of goods sold, or unsold will be recorded as ending balance of inventory. There are also two different systems to record the inventory: perpetual system and the periodic system. Remember in chapter 7 we talked about the receivables. We introduced the gross methods and net methods. Okay, methodology are similar. Let's first take a look at perpetual system. Perpetual system basically is to update inventory account whenever the transaction have impact on the inventory. If firm purchase inventory, we are going to debit inventory. If the firm sells inventory, we are going to credit inventory. Because we keep updating the inventory accounts, by the end of each accounting cycle, the ending balance will be available. The perpetual inventory system provides a continuous record of inventory and the cost of goods sold. Different from perpetual inventory system, periodic system just update inventory once. When? The end of accounting cycle. So if there's any purchase, we will update to the purchase account. Now, let me use an example in the PowerPoint to show you the difference between two systems for the same transactions and events. Beginning inventory, number of units 100. The cost per unit is $6. So the book value of beginning inventory is 600. During this accounting period, the firm purchased 900 units and each cost $6. So the book value of the purchase is $5,400. By the end, the firm learns it sold inventory 600 units. The price is $12. So the total sales revenue or sales is 7,200. And ending inventory is 400 units, still at $6. Because the beginning and the purchase inventory are all $6. So the total amount is 400 multiply $6. Number of units. So beginning 100 units, purchase 900 units. The ending is 400 and sales is 600. It also applies to the costs. Beginning $600, purchase 5,400, and the ending inventory is 2,400. So the cost of goods sold 3,600. Yeah, so this is the cost of goods sold. 7,200 is the sales revenue. So actually, in this accounting cycle, this firm generate revenue 7,200, cost of goods sold 3,600. So the gross profit is $3,600. Based on the given information, let's take a look at what's the difference between these two systems, although they are all based on the same fact. Beginning 100 units, price $6. So there's no journal entry because this is just the beginning balance. There's no transaction. How the perpetual inventory system record the purchase? The $5,400 purchase, we update the inventory by debit inventory. So this is a purchase on account, so we credit accounts payable. If it is cash purchase, we're going to credit cash. And next is sales of inventory. The firm recognize revenue, and also this imply this is credit sales. So we debit accounts receivable and credit sales revenue. Cost of goods sold, as what I calculated in the prior slide, right? So the total cost of goods sold is 3,600. So we debit cost of goods sold and credit inventory. Here, when the firm purchase, it debit inventory. When the firm sells inventory, it credit inventory. So by the end of the accounting cycle, there's no journal entry because there's no transaction, right? We can based on the equation to calculate the ending balance of inventory is 2,400. The periodic system, as I said, it only updates inventory account once at the end of the accounting cycle. So when there is a purchase, we do not debit inventory, we debit purchase, which is a temporary account. Next, same as perpetual system. And when firm sells inventory, we do not credit purchase. Basically, there's no journal entry. By the end of accounting cycle, we need to update the inventory balance. Actually, what we find is these four accounts are just the four items in the equation. Beginning balance, purchase, so total, this is goods available for sales. Because cost of goods sold is 3,600. Why? Because 600 sold, each $6. Then the inventory balance is 2,400. See, we only update the inventory balance by the end. During this period, we do not make changes to the inventory accounts. Sometimes the amount recorded in the book is not same as the actual or physical inventory amount. It may be due to different reasons, for example, loss or theft. By the end of accounting or reporting period, the firm need to check whether there's any difference between book and the physical value of inventory, and then make adjustment in the book. So in this example, the inventory book value is 4,000, but physically the inventory is only 3,800. So that means the book overstate the inventory by $200. Because overstatement, we should write down the value of inventory. We debit inventory over and credit inventory. Then the book value of inventory will become 3,800, which is same as physical value of inventory. If understate, we're going to debit inventory and credit inventory short. So what's the inventory over and the short means? It adjusts cost of goods sold. Okay, so if overstate, this will increase our cost of goods sold. If inventory short, this will decrease the cost of goods sold. So in practice, companies sometimes report inventory over and short in other revenues and gains or other expenses and losses. Inventory control and management. Because inventory are valuable assets for the firm, all the companies need to verify their inventory records by physical count, weight, and measurements, and also compare with their book value. Check the physical inventory near the end of the fiscal year will help the firms to properly report inventory quantity in their annual reports. Based on this template, we can use it in the future to determine cost of goods sold or ending inventory.